All right, resolved. Thank you everyone for joining today. So welcome to the Essential Options Understanding course. We've gone through quite a bit if you've attended these sessions, but today we're going to focus on understanding calls and puts. So last time we focused on options pricing. Before that, we talked about getting started with options. Today, we're going to take that to the next level where we just dive deeper into how calls work and how puts work, both from the buyer and the seller's perspective. If you do not know me, I'm Jessica Inskip, the Director of Education and Product over at OptionsPlay. My job is just to take complex concepts, simplify them, make sure they're in the most understandable, cohesive manner. So let's dive in. And actually, have to give you just a quick disclaimer. Know that we're going to use a lot of examples today. Sometimes we pull up real securities. They are for informational and educational purposes only. Does not constitute legal, tax, or investment or planning advice. Additionally, we're a third party that's not affiliated with First Trade in any way, shape, or form. So anything that we say does not reflect First Trade in the slightest. And know that options aren't for anyone, or excuse me, aren't for everyone. They involve risk. They require a separate application and approval process. You might have seen something called the options disclosure document if you've signed up for options. If you haven't, it's important. It's something that you see. I'll make sure that I plop that in the chat so everyone has access to it. But essentially what it is just goes over the characteristics and risks of options. There's a lot of terminology and components. This is largely educational, so what we're saying is found within that document, but it's important for you to have access to that and know that. All right, without further ado, let's go into what we'll cover. So we'll do a review of calls and puts, just what we've talked about briefly in the previous sessions. We'll talk about an option chain. So the first time that we're going to introduce it to you in this session, you might have seen one before, but it's important to know that options are priced different than stock. So there's a different way that we view a quote. We'll go through that. Then we'll focus on long and short equity calls. So equity options just means a stock or an ETF. And we'll talk about long and short equity puts, shift over to the other side of the chain on the put side, and then we'll put it all together and save some time for some Q&A. All right. So let's talk about what an option is. You probably have seen this slide before, but it's important to cover it and understand it. So it's simply a contract between a buyer and a seller, and every contract has legal terms and obligations associated with it. And if it sounds like it's jargony, it certainly is, because it is literally a legal contract between a buyer and a seller. So the buyer pays a premium for that contract. Therefore, they can execute upon the terms of the contract. They own the rights to that contract. That means that they want the contract to have as much value as possible because they can enforce the contract. They are, using the car analogy, they're the driver. They say if it's stopped, left or right, because they're the ones who are pushing the gas, hitting on the brakes, so on and so forth. Sellers, they're the passenger. They're on the other side of the contract. They're obligated to fulfill the terms of the contract. They receive the premium, so they keep that premium, but they don't want the contract on an individual basis to have any value at all. They don't want it to be executable upon. So that's in this most simplistic terms. Just on this example, this contract, say, represents 100 shares of ABC at $100 per share. It's executable at any time through the expiration period. If it's issued as a call, that simply means that it contains the right to buy. And if it's issued as a put, that means it contains the right to sell. It's something I want you to keep in your mind anytime we have these terms, which we'll show on the next screen. But just something that helped me early on in my career just to put the puzzle together is anytime you hear the word long, we say change it to purchased in our mind. The word short, sold, call, the right to buy, and put, the right to sell. So if this was a long call, we'd say we purchased the right to buy 100 shares of ABC at $100 per share. And that helps when you put everything together with a chart like you're seeing on your screen right here. So if you haven't seen this before, this is what we call a T-chart, where we put calls on the left and we put puts on the right. Long calls are on the top quadrant and then short calls on the bottom. And then we do the inverse on the other side, short puts on the top and then long puts on the bottom. And there's a reason for this. If you set it up in this structure, you'll notice that all bullish strategies are found on the top half. That's why they're green or associated with that bull, because they contain a right to buy or an obligation to buy. There's a purchase associated with that. Both of those strategies are bullish. Where the inverse is true, short calls and long puts, those are bearish strategies and contain either the obligation or the right to execute upon a sell transaction of some sort. So the purpose of this is if you understand long calls inside and out really, really well, you can use this chart to figure everything else out because of the mirror relationships that are associated with options. So it's just a tip and trick to really figure everything out. All right. Okay, so let's start with the option chain. So this is something you probably have seen before. Let me talk you through exactly what you're looking at. So like a traditional quote, you're going to have a last price and a bid and an ask, which is what we see here. The difference is even though you may have an underlying security like this stock, it's masked to be called ABC, but it's a real stock. It has a lot of volume. So that's how many times it is traded that day by 12:30 p.m. So we're not even, towards the end of the day. So that's quite a bit of volume. However, you can notice these options, even if they expire one day until expiration, which is a lot of the popularity is upon trading, there's not an equal distribution of volume. And so therefore we look at different figures like the bid and ask, because they get wider, the less liquidity that's there. And liquidity means volume. So there's a lot of transactions. That's what it is. A last price, which is this column here, or this price here, just simply means the last time something was traded, this is the trade that it was at. If you have something that trades 29 million shares a day, you can look at the last price to give you a good idea because it moves every millisecond or faster than a blink of an eye. So that's a good representation of the market's price of the underlying security or the security. Whereas if you have something that's less liquid, like this 147 or even this 98, 63 here, that's probably the least, you'll notice that the difference between the bid and ask widen. And that's because there is less volume, less liquidity. So that's what we would look at to understand the price of an option. And there's so much more details we can go into that, which I will spare you of today. But that's the ask is the price at which retail clients buy. The bid is the price at which retail clients sell. The difference of those two is what we refer to as the spread. And that's what the market maker actually takes on for order flow. But it all kind of puts the puzzle together because the market maker gets paid by orders. If they have less orders, you have a wider spread. So that's why you see less liquidity or less volume. Things have a wider, the difference between the bid and the ask. So, and I also love to preface that with a lot of times I get asked the question about limit order execution and things like that. They just want order flow. They don't care if it goes up or down. They keep a delta neutral portfolio. So just knowing that's the mechanics is helpful. Again, too much information for this. But let me give you the layout of what this looks like. So specify it by calls and puts. Again, calls on the left and puts on the right. Your strikes are going to be right in the middle. So this is our agreed upon price at which we can execute upon the terms of the contract. If it's a call side, just means it's the right to buy, put the right to sell. That's simply it. We have our last price. So that's literally the last time that it was traded. If it doesn't have a lot of volume, that could mean it could be a month ago. It could be 2 weeks ago. So if you see something with not a lot of volume, that's why we look at the bid and ask. And the change, of course, is the difference from the time that the last price that was traded. We went over the bid and ask. So the ask is where we buy, the bid is where we sell. If you see something really wide, prudent to specify a limit order. Doesn't guarantee execution, but certainly can help. And then your bid and ask size is just the amount of shares or contracts, in this case, that's attached to that. Volume, just like with the stock, that's what has traded today. So that updates tick by tick or trade by trade. But you don't know if, because with options, we can buy to open or sell to open. We don't know if it's an opening or closing contract. So what happens on daily is something called open interest. specified here by interest, that's just the contracts that aren't in existence. So that tells me, so they take all the buy and sell orders because you could have been closing or opening. It's all configured by the end of the day. And the next day you get the contracts that are in existence. So what's traded, what's in existence. And then you have, of course, the different expirations, which you can select and adjust and so on and so forth. You as a first trade client have access to the OptionsPlay wizard, which is a version that you see here. Know that this was designed to go through the options chain for you, has the same amount of data, just in a different format. That's where these are here. And know, again, securities are purely for illustrative purposes. But we're not going to go dive too much into the tool. I just want you to know the resources that are available to you. And of course, go through that option chain. So let's talk about a long equity call. So in this example, we've got, if we were going to enter into the transaction, so our entering moment on the trade ticket, it would look something similar to this. I'd buy to open one ABC call expiring on September 23rd. Let's assume that's 30 days from now, or time frame doesn't matter at this point, at a strike of 150 for $7 in premium. So I've purchased it. So I own the right to buy 100 shares of ABC at $150 per share at any time through the expiration period, and I paid $7 for that. So I am long the call because I purchased the right to buy ABC at $150 per share. That's what we need to know. When you're long an option, but when we're long a call, first of all, we're bullish. We want the stock to go up in value as much as possible. So if you've never seen a profit and loss diagram, it's a really good visual representation that tells me if I have limited risk, unlimited risk, an unlimited gain potential, limited gain potential, if it's neutral, things like that. So let me explain that. So in the bottom here is our loss, and this is our gain area. This is the stock going up in value, and this is assuming at expiration. So I know that I have limited risk because this line is flat and it stops. So no matter how far down the underlying security goes, and remember, we're bullish if we bought a call, but no matter how far it goes below 150, I can only lose $700 or $7 per share, because remember, one contract represents 100 shares. But at expiration, because I paid $7 for this, that means I need to have the underlying security move more than the extrinsic value or that I purchased. We're assuming this is an at the money option, which means my gains begin when it moves above that, but I have unlimited gain potential. It doesn't matter how high ABC goes. I could still capitalize on that appreciation because I own the right to buy ABC at $150 per share. And theoretically, ABC can go to an infinite amount. Will it? How far will it go? That's when we layer on other processes to define that. And it's important to have a strategy on the entry and exit point. But prior to that, what's more important is understanding how the strategy works. Now, this is assuming, again, holding till expiration. That's as we tend to the previous session, and we talked about options pricing. We know that time is something, if this was all in extrinsic value, the $7, that time is something that moves against us. And that's why we have to overcome this, because we purchased $7 worth of time. Therefore, we need to go this to move up higher by expiration. But if we purchase time, we don't have to hold an option till expiration. We can also sell back time and close it prior to its expiration date. And that's where that exit strategy comes in. Something we'll talk about later on, but make sure you keep that in your mind. So then this just goes into the risk that's associated with it. When we're buying the call, our max risk is the amount of premium that paid. This occurs if the stock declines or remains even at 150. We break even when it rallies enough, equivalent to what we paid the option for. And that's, again, assuming at expiration when the stock's at 157. And we can gain, and gains begins as soon as the stock is above 157 and it has unlimited potential. So it's a good way to think about where is my risk and what is my reward is something we also want to focus on. Now let's look at the other side. If I were entering into this transaction as an opening transaction, I would sell to open one ABC call expiring on September 23rd at a strike price of $157. This means I am required to fulfill the terms of the contract. So in the previous example, I had the right to buy 100 shares of ABC at 150 per share. I'm going to probably, or may not, but I could, and it makes more sense for me to execute upon the terms of that contract when it has value, which is when ABC is well above 150 per share. Then you can see when I say I want it to have as much value as possible, that means I want ABC to go up as much as possible throughout that time frame because it's how it has more value. Now, everything flips. As the stock goes down, because I'm obligated to fulfill the terms of that. So if ABC were to go up beyond that same break-even point of 157, I would be obligated to fulfill the other side of that, which means since ABC can go to an astronomically unlimited price, that I would have to buy the shares at the market, whatever price that is, if it's $200, and then sell at 150 per share because I agreed to those terms by selling that call option, which is how this strategy has unlimited loss potential if you do not own an offsetting position, which is just owning the stock itself or a long call. So the max risk for this, as the stock goes up in value, you have completely unlimited loss potential because again, ABC can theoretically go to an infinite price. Break even is exactly the same. As the underlying security moves up, that is where the obligation kicks in. So this still would be what we call an in the money option because the right to buy at 150, if the market was at 157, is much more favorable than 157. So, but if I have to buy at 157 and immediately sell at 150, I received a $7 premium, so it offsets itself. So the difference here is the $7 just becomes my amount that the security can move before I start losing money. Whereas the other is the inverse is true with the long equity call is that's the amount that the security needs to move before I begin making money. And then the trading or the offset, or you can see how hopefully it's putting the puzzle together and you see how everything really is a mirror, is this has limited gain potential because no matter how low ABC goes beyond 150, I am capped. I will not make any more money. The most that I can make is $7. However, the most that I can lose is unlimited because it can go to a infinite price. So you can see how the mechanics are similar just as far as where the strike price is, the break even, and the gain potential. It just flips completely. If you have unlimited risk potential on the short call side, we have unlimited gain potential if we were to buy that option. We start losing money when we reach our break even point on the long side, and the inverse is, I'm sorry, we start gaining money when we break the break even point on the long side. We start losing on the short side, and then we have limited gain potential on the short side, but limited loss potential on the long side. And anytime you're long options, you have limited loss potential, as in you can only lose the amount that you spent because you are in the driver's seat and you are the one saying, yes, I'd like to execute upon the terms of the contract. If you are short the call or you're short an option, you've sold the obligation, which means you're obligated to do what the driver says. And I like to use the driver and passenger analogy quite often because as a passenger, you can get an idea if someone's going to go left or right or come to a stop sign. You may not know if they'll do it, but you can get an idea based on your surroundings. And that's another conversation we can talk about as far as that obligation kicking in. So let's go through some examples, and this certainly will help put the puzzle together. Still have the same exact option. So we're just looking at one ABC call expiring September 23rd at a strike of 150 for $7 per share. So 700 total. We've got a long call purchaser and a short call writer. Writer also means sold. So when we say long call, we say we purchased the right to buy. Short call is we sold the right to buy. The long call purchaser, they're bullish. They have a $165 price target, and they feel like that the underlying security is going to reach that within the next 30 days. Now, if you're a short call or short a call, you're actually neutral to bearish, meaning the underlying security could stay exactly where it is and you'd still be profitable. But if it moves down, you will also be profitable. You don't need a sharp directional move. Whereas when you purchase options, you need a sharp directional move. They have a $150 price target. So this short call writer thinks that ABC is going to stay exactly where it's at. They enter the trades when ABC is at 150. The long call purchaser buys when ABC 150 September 23rd call at $7. They paid $7. The short call writer just does the inverse. They sold to open rather than purchased to open, and they received $7. Know that there are margin requirements and other things that's not discussed today that also has other risks associated with it, but this is purely just for the educational aspect. So paid 7, received 7, we've got our price targets and our time frame. Break even is the same. So we know that let's just see what happens throughout the expiration period. So let's say we get to day 15, halfway through the life of our contract. ABC goes exactly where the long call purchaser assumed it would. They sold to close their ABC call at 17 and they received $1,700 total. They had to buy to close their option at 17 and they paid a premium of $1,700 total. Now, if you're thinking, okay, this is a little more, that's because there's still time value associated with it. That's something that's important to know when we look at the day 15 and why we placed it this way, because if it's the right to buy at 150 and the market's at 165, that extra $2 is just extrinsic value. That's where that 17 came from. The long call purchaser made a gain of $10 per share or $1,000 total, where the short call writer lost $1,000 total. So the gain will be the loss, and this will be true for the long call purchaser and the short call writer of the same contract. So let's say they held until expiration. So let's go to the expiration date. And ABC just moved up only $1. You'll notice that this moved down because the option is only worth its executable value on expiration. So now it's only worth $16. This gain was reduced to 900 and then this lost to 900. The time depletion did not favor the long call purchaser, but it did favor the short call writer. The sharp movement favored the long call purchaser. It did not favor the short call writer. And that's because this is why it's important to understand the mechanics of options before you start trading them. This is bullish and will always benefit from a sharp directional move if you're purchasing the option. Whereas this short call writer, most of the short options are neutral depending on where you layer strikes and then have a slight directional bias. And any sharp directional move actually equates to risk because you could be unprofitable really, really quickly. All right, so let's see what happened if ABC was very sideways and just went to 150 on day 15. Well, the long call purchaser could say, you know what, I expected it to go to 165. It hasn't moved at all. I'm going to go ahead and sell back some of that time that I purchased. And they decided to close their option for $5, 500 total. There'll be a loss at 200. And if the short call writer said, you know what, it stayed where it was, it did it with 2 weeks to go, I'm going to go ahead and capitalize on that time that's depleted and buy to close my option at a cheaper price at 500 and have a gain of 200 total. So you can see there how the time value, who it benefits and who it does not. And let's say ABC went way down to 145. The long call purchaser, that definitely went way against their time frame. And if they would have closed earlier, they could have captured that time value. They didn't in this case, but they were limited to their loss of the amount that the premium that they paid. The option would expire worthless. It'd be pretty difficult to close the option because someone has to take the other side of it. So there may not be a bid available. But so in this case, it would just expire worthless. The short call writer would have their full gain potential of $700 per share, but then they also have a little more risk because they held it until expiration. But you can see how time value completely helped the short call writer, but their maximum gain still stays the same, which is the premium that's received. All right, so that was the long equity call side. I tend to spend a lot more time on the long equity call side just because, like that previous T-chart, if you understand a call inside and out, you can figure everything else out. Because now what we're going to do is just literally the same thing. We're just going to flip it all over. Instead of on the long equity side being bullish for a call, just going to be bearish for a put. And we always look at things through the eyes of the purchaser. So if I have a long equity put, the way that I enter the order, you buy to open one ABC put expiring September 23rd, a strike of 150 for $7. That just means I own the right to sell 100 shares of ABC at $150 per share at any time through the expiration period. So all the way up until that option expires 4 p.m. that day, I can execute upon the terms of that contract if I want and sell 100 shares of ABC. And for that right, I paid $7 for that, which means that I own the right. I'm the driver. So the most that I can lose is the amount that I'm paying. I do need the underlying to move lower, decline more than the premium that I paid, that $7, so to 143 before I can start having any gain potential, of course, on expiration, because we talked about the time factor. We have substantial gain potential because the underlying could go as low as 0, theoretically. And if this is at 0, this would be worth quite a bit. However, it's important to have an exit strategy and have a target of where you feel like that security is going to go. So the break even is just simply if the underlying security moves more than the extrinsic value purchased, we'll break even at that point because we'd have the right to sell at 150. If we were to buy at 143, we'd make a gain of 7, but that's offset by the $7 that I paid for the contract. And then, of course, max gain substantial as it goes to 0 and it moves below the break even. So you can see how this is extremely similar to the long equity call. The difference is the direction. Now we're just looking for a downwards movement rather than an upwards movement. And that's all it is. Now, you notice the word substantial when we're looking at the sell side of the put. The put or a cash cover put does not have unlimited loss potential because the stock cannot go down beyond 0. That's the stopping point. So it has substantial loss potential. So what's important to know there is just the mechanics of the option. We'll talk a little more in detail. You'll notice that the break even and the strike price, everything is the same because this is the same contract and we're looking at the sell side. So our max gain is going to be limited to the premium that's received, and that kicks in when our obligation doesn't make any sense. Meaning if the person who is long the equity put, they own the right to sell. So selling at 150 is what they have. If the stock in the market is higher than 150, it doesn't make sense for them to execute upon the terms of that contract, which is why this is a bullish strategy. If ABC is above the strike price, then we're at max profit because it doesn't make sense to execute upon the terms of that contract. And then the in between just becomes our risk zone. We'll start losing our profit potential until as it declines to 143 because we're obligated to buy at 150 if somebody wants to sell at 150. And then substantial loss potential from there. And we'll take you through the same exercise with a long equity put, but I have a couple different examples in here. So same contract, one ABC put expiring September 23rd, with a strike price of 150 for $7. The long put purchaser, they're bearish. They have a 135 price target. So they are expecting a very large directional move to the downside. And they feel like that's going to happen within 30 days. The short put writer, they're neutral because remember, they can be profitable as long as ABC is right at 150 or just a penny higher. No matter how high it goes, they're still going to be profitable. So that's considered neutral. And that's why we don't want a sharp directional move right here. They are expecting a slight directional move to the upside of $5, but are willing to accept a $7 premium, and they have a 30-day time frame. So the way that the trades are entered, we buy to open on the long put side, sell to open on the short put side. Let's say ABC goes to 140. So really declines in value, not the exact purchaser price target, but relatively close. We'll be able to close at 11 because remember, there is some time value associated with it. So the long put purchaser received a premium of 11. They had a gain of 400 total. And then the inverse happens on the put side. Let's see what happens if ABC is at 135. So, let's see, it did the math again where I didn't update it. I apologize, but let's say it's at 15 and it's at 15 here. Now there is a gain on the long put side because it went to our price target, but we still lost some time value, which is important to know. And then the short put writer had a loss here. And then if ABC is at 143, so now we see if we are at the break even point, this is what's important to know. This math is not correct. I apologize. Oh, I apologize. No, this is right. So ABC is at 143. We're at day 15. So we closed for 9. And the reason why this still has some value for the long put purchaser is because of that time value component. If it is moving not as much or in the velocity that you're assuming past your break even point, you can still sell to close some time. And this time is going to decay, which means we still have some movement that's needed to be profitable. And we need it to move more than 147, or sorry, 141 at this point. So that's important to know here. Whereas time still is something that could decay that would help this short put writer. So if it remained the same, they would be at less of a loss, which occurs here. So now they're not at a loss, break even. This long put purchaser has lost the time value that was priced into that option. So that's the lesson that's there. There is light amount of time value. It decays. That's going to hurt the long put purchaser. It helps the short put writer. The risk, of course, is the stock moving in your undesired direction, in which case it stayed the same, therefore both broke even. And one last scenario, if of course it went up to 154, didn't hit the price target, however, it expires worthless, which is what we're looking for as a short put writer. So I have my maximum gain of $700. And then I cannot close the option for the long put purchaser. So therefore I've lost the amount that I've purchased, my maximum loss potential of $700 per share. And that's where we end this and give you this 4 quadrant where we really adjust and think about our goals and build and broaden this. So hopefully you saw with the long call and the short call, mouse is so sensitive, how there is that risk profile. I know that when I purchase an option, I want a sharp directional movement in my desired direction. So for a long call, I profit from a sharp upwards movement. That's because I have to overcome the premium that I paid. And then the inverse is true with this long put. It just as in directional movement downwards. As I purchase the option, I still purchase time, I purchase extrinsic value. That's something that's going to move against me, which means I need sharp movement to be profitable. Those are those goals that's important. So when I purchase options, I'm just expecting a sharp move in my desired direction, and time is something that works against me. When I sell the option, my goal is just for the maximum gain where it's achieved is when the option expires and I can keep maximum credit. So I just want that option to not have any value. That's what happens when the option expires worthless. Time decay works for me because as time goes by, it depletes the option's value, which is my goal. And then I, of course, profit from neutral or little movement in my directional bias, in this case, downwards. And then you can see the same characteristic for the short put. Time decay is positive. I just want the option to expire worthless so I can keep my maximum credit, and I profit from a neutral and slight upwards directional movement or bias. So the purpose of this presentation today was really for you to understand the mechanics of long calls and short puts and hopefully put the presentation or the puzzle really all together. But these are the key takeaways is I purchase options. I have a strong directional move that I anticipate, and time decay is negative. If I'm short options, I have a neutral outlook and a slight directional bias, but time decay is positive for me. And that's when we take this and now we go on to our strategies and we apply this where the first step is understanding your strategy, the components of it. Then we understand optimal environments of our strategy and structure that based on the positive and negative factors. And then, of course, define our sentiment, make sure it aligns with the strategy sentiments. We have to know how they work. And then have our exit strategy based on price targets and timeframes as well, because we're dealing with options. So that's where we'll transition next, where we'll talk about covered calls 2 weeks from now. But with that, we'll have a couple moments for any questions. If anybody has some, please feel free to put it in the Q&A window or the chat if you have access to that. Well, that is a fun question. What strategies would you recommend around Fed meetings? So no, we can't give advice or recommendations on behalf of the brokerage firm. But this is where it's important to understand the mechanics of options. So this is a different Fed meeting, but around Fed meetings, there is a lot of uncertainty and volatility, and that is a component of an options premium when we're talking about the options pricing. So that's where we would understand if that is also that increased volatility is translating into the options premium. That's step number one. Then it's also your outlook. Do you expect a rally or a decline? How do you feel the Fed's going to do? Or do you have a strong support and resistance point on a specific security? There's so many things. It depends on your outlook and what you think the Fed will do and how the market will react to that. You could literally trade the broader markets. You can look at something more sectors. So cyclical versus non-cyclical or defensive versus non-defensive, even bonds. There's so much you can do with that. It just depends on your outlook. Once a person understands, would you say trading options is better and safer than buying stocks? No, I would never say that. Even though if you understand it, it's inside and out. And the reason is options have an expiration date and their pricing mechanics are very different from stocks. It relies on the stock price, but it also relies on implied volatility, and interest rate risk. Time frame is all ever so important. I mean, personally, I love to trade options, and I think options can help enhance a stock portfolio, but it's definitely not. I would never say that it's safer. It's riskier. You have to have a separate approval for it for a reason, because there are a lot of mechanics that go on with options that could end up putting you in a really bad situation really quickly if you don't understand it. Of course. Taking the time to understand it is definitely step number one. And that's where we'll shift next. Options can be used because they have an expiration date for the long term, for the short term, for trading, for creating income. There's so many uses of options. And really you take the best and worst and even layer them together. So next week or 2 weeks from now, we'll focus on covered calls and talk about the mechanics of that and executing that in a little more detail as we get into strategies. All right. Well, I don't see any other questions. I appreciate you taking the time to educate yourself today. Any questions or concerns, please reach out to First Trade, especially if you have topics that you really want to see. Let them know. They'll let us know, and we'll make sure we cover those for you. Have a wonderful day. Happy Fed Day, and we'll see you soon.